Hey guys, so today I have this day trading strategy which I'm going to backtest for you over 100 trades. So I will first tell you about the indicator that we're going to be using, show you a few examples, and then perform the 100 trade backtest. So this strategy involves one trading indicator, and it's the stochastic oscillator with the use of price action. So the stochastic oscillator is a momentum indicator comparing a particular closing price of a security to a range of its prices over a certain period of time. The sensitivity of the oscillator to market movements is reducible by adjusting that time period or by taking a moving average of the result. So it is used to generate overbought and oversold trading signals, utilizing a 0 to 100 bounded range of values. So I'm now going to go into details as to what the stochastic oscillator tells you, but feel free to jump forward to the strategy chapter. So the stochastic oscillator is range bound, meaning it is always between 0 and 100. This makes it a useful indicator of overbought and oversold conditions. Traditionally, readings over 80 are considered in the overbought range and readings under 20 are considered oversold. However, these are not always indicative of impending reversal. Very strong trends can maintain overbought or oversold conditions for an extended period, but instead traders should look to changes in the stochastic oscillators for clues about future trends shifts. So the stochastic oscillator charting generally consists of two lines, one reflecting the actual value of the oscillator for each session and one reflecting its 3-day simple moving average. Because price is thought to follow momentum, the intersection of these two lines is considered to be a signal that a reversal may be in the works, as it indicates a large shift in momentum from day to day. Divergence between the stochastic oscillator and trending price action is also seen as an important reversal signal. For example, when a bearish trend reaches a new lower low, but the oscillator prints a higher low, it may be an indicator that bears are exhausting their momentum and a bullish reversal is brewing. So this backtest is based on the daily time frame with a minimum of 1-to-1 risk to reward ratio. So that means that every dollar that we risk, we aim to make a minimum of $1. So here's the strategy. So we buy when price is making higher highs and stochastic enters the 0 to 20 zone, but we also buy if we're in a short position and the price enters the 0 to 20 zone without breaking through the last swing low. And similarly, we sell when the price is making lower lows and the stochastic enters the 80 to 100 zone. And we also sell if we're in a long position and price enters the 80 to 100 zone without breaking through the last swing high. We place the stop loss at the last swing. We have no maximum number of trades that we can have open at any given time. And we move the stop loss to break even when the profit is equal to the maximum risk that we are risking per trade. And we have a minimum of 1-to-1 risk to reward ratio. All right, guys, so here we are on euro dollar on the daily time frame. So we'll go ahead and add the stochastic oscillator. So we can just type it in, it's the default. And we can change the settings to a tighter setting, so it's 331. And you can change the colors if you want, but essentially what we are interested in is the D line. So as you can see, it's the orange one that we can see. So I'll show you a few trades and then we'll dive into the 100 trade backtest. So there you go, a few examples of the trade based on the strategy that we've talked about. So essentially we are looking for both long and shorts at any given time based on the price action and the stochastic oscillator's status. So here, as you can see, the price broke the last swing low. So we're looking for a short trade. So the stochastic oscillator reaches the 80 to 100 range. So we take a short as soon as this happens. We put the stop loss to the last swing high. which is right here, but we take a loss. That said, the price goes up and breaks the last swing high, so we're looking for a long trade. The stochastic oscillator reaches below the 20 mark, so we take a long. And here we put the take profit at the last swing high, so it would be here for a 1268R. Then we go long. We are still looking for a long as the price hasn't broken the last swing low. So again, the oscillator goes below 20 and we take a long. The stop loss at the last swing low, but it's a loss. Similarly here, the price continues to go down. It reaches above the 80 line. We take a short, the stop loss at the last swing, but this is a loss. Same here, this is a loss. But here you would have had a 1-to-3 risk reward ratio, so you would have regained the losses you would have incurred. Here you take a loss, you take a 2.5 win here, and this is an example of a break-even trade. So you take a short here, and as you can see, the price reached a 1-to-1 risk reward ratio. You would have moved your stop loss to break even, and you would have waited to see what would happen. So essentially you would have been stopped out at the break even here. So let's go ahead and perform the 100 trade backtest, and I'll see you for the results. So there you go, the results on euro dollar. We had a maximum drawdown of 19%. We were risking 5% per trade, and we had a risk to reward ratio of minimum 1-to-1. We had 43 wins and 45 losses, 12 break-even trades, and we had 6 wins in a row and 4 losses in a row. So that gives a pretty amazing win rate of 49%. Over a duration of 7 years. So we had a total profit of 372.5%. If you had started with $10,000, you would have had $37,253. So 372.5% over 7 years is 53% a year. So that's pretty insane, especially if you start compounding your account. So the drawdown was pretty low, and as you can see from the graph, the growth rate is pretty stable. So it's a great strategy. The risk to reward ratio is pretty variable, but as long as you have a minimum of 1-to-1 risk to reward ratio, you will have good results. We had quite a lot of trades that had a 1-to-2 to 1-to-3 or even 1-to-4 risk to reward ratio. That definitely helped. So that's definitely what to look for. Let me know what you guys think. If you can think of a way to improve this strategy or reduce the drawdown or even increase the rate of return, let me know in the comments, and I'll see you in the next video.